Okay, there is a new ETF called TSLY that's offering a massive 75% dividend yield, and honestly, it sounds too good to be true. On the surface, the yield is so high, it looks like a total scam and reminds me of some of those sketchy crypto Ponzi scheme projects from 2021. Now, for context, a 75% yield means that if you invested a lump sum today and the ETF's price stayed the same, in less than 1.5 years, you'd have earned all your money back just from the dividend alone. So then you're playing with house money and earning effectively risk-free passive income. That sounds ridiculous because we're all used to dividends coming from stocks of large companies and their profits, which usually means yields in the single digits. But the biggest myth about this ETF is that it's a total scam. So let me show you what I found when I did my research. The yield max ETFs like TSLY take advantage of volatility and use options trades to generate such a high yield. In the case of this ETF, the fund managers will make trades as often as every week rather than just buying options contracts and waiting for them to expire like other covered call ETFs. This is far from your average dividend, which is why the yield is far from average too. So the stock, strategy, and active management are why this ETF can get such a high yield. So I think saying it's a total scam based on just looking at the yield alone is inaccurate at the very least. However, we will address the absolutely horrendous price chart for this ETF that screams dividend trap, as well as a few other things investors need to know to make an informed decision, because in this case, this could be an opportunity in disguise for the right investor. Remember, I'm not a financial advisor and this isn't financial advice, it's just my research that I condensed down and put in this video for you. So if you appreciate that, click the like button and let's get into it. Alright, so first, the basics. The fund's primary goal is to seek income. Honestly, I really like that they're just forward and direct with the main purpose of this ETF, and making money is kind of the whole point of investing, so I'm already a fan. The secondary goal is to seek exposure to the share price of the common stock of Tesla, and I think that's the most important part. That's the secondary goal. Its main objective is making money. The thing here is that if you buy TSLY, you are not directly buying shares of Tesla. The website makes that very clear. But the price of the ETF will correlate to some degree to the price of Tesla, with a catch. The ETF uses a covered call strategy, so yes, it can generate some massive profits using options, but the covered call strategy also caps gains. If you're not familiar with covered calls, they are a form of investing that allows someone who owns at least 100 shares of a stock to sell the option to someone else to buy those shares at a certain price. Depending on where the stock is trading at the time and the volatility of the stock in general, the buyer of the option pays for the ability to buy shares at a specific price, and this is referred to as the premium. The seller of the option gets to keep the premium even if they have to sell the shares at the predetermined price. Because the fund doesn't own the shares of Tesla directly, they use a synthetic covered call strategy, which basically means they use multiple options contracts that combined have similar results when compared to owning the shares for the covered call strategy. I know that got very technical very fast, and explaining how covered calls work is a great idea for another video. For now, what you need to know is that this fund is actively managed and they handle all the research, buying, and selling of the options contract for you. In my opinion, the ideal investor for this ETF TSLY is someone who wants to make money from Tesla stock using a covered call strategy, but doesn't want to actually manage the positions themselves and doesn't want to risk at least 100 of their own shares to do it. If that's not you, you don't have to worry about this ETF at all. There are plenty of other investing options for you, but if you want to take advantage of Tesla's volatility and someone else's trading experience, then this might be worth looking into, especially since in the case of Tesla, you would need to own over $20,000 worth of stock just to get 100 shares to even be able to sell a single covered call on your own, which isn't affordable for everyone, or not worth the risk to put all that money into one position, or not worth the reward because every covered call options contract you sell requires at least 100 shares, and there's only so much profit you can squeeze out of one position at a time. This ETF is very new. It's only been around since November of 2022, but its dividend distribution started in January of 2023, and it's been paying out close to $1 a share most months, with some significant dips along the way. So this ETF's goal is to provide income, but I would not count on this as being consistent or reliable by any means. Overall, the fund is managing an impressive 75% dividend payout with an expense ratio of 0.99%. Now, I do recognize that this is high as far as expense ratios go, but remember, this fund is actively managed and trading can happen with these options on a more frequent basis, which in my opinion might be necessary on a stock as volatile as Tesla, and with a yield this high, that seems like a small trade-off. But we do need to address the elephant in the room, the price chart. The main warning thing everyone should know about this ETF can be seen very clearly from just comparing the price chart of the ETF TSLY to the Tesla price chart. If you can't handle the ups and downs of Tesla, this is not the ETF for you. When Tesla moves up or down, so does TSLY, and because of the limitations of the covered call strategy, Tesla moving up in price will mean there will always be profits left on the table that TSLY simply cannot capture. And in bearish markets, TSLY will probably not perform as well given the nature of covered call ETFs. So if Tesla continues to decline in value, so will TSLY, and investors might be stuck in a dividend trap despite the high yield. And depending on what accounts you hold it in, you could end up paying taxes on your dividend income and effectively be paying to lose money, which means you lose twice. So overall, bullish and flat markets are better for TSLY's performance compared to bear markets, and it's also tied to how the Tesla stock is doing itself, which might make this investment very appealing for a long-term Tesla bull that can pick up a lot of shares right now for discounted prices. You can reap the rewards when the market turns around, or this investment could be very unappealing for an investor looking for simplicity and predictability. And if you are that Tesla bull looking to buy TSLY, don't make the mistake of thinking the high yield will cushion your fall. Yes, it will help, but remember, if the price of TSLY goes down but the yield stays high, your dividend payout is still going to be lower because the dividend yield is a percentage of the overall price of the ETF. For simple math, 70% of $20 is more than 70% of $13. Bottom line, I think TSLY is an interesting option for a specific kind of investor. It's certainly not for everyone as it has major pros but also major drawbacks. Of course, no risk, no reward though. For me personally, this ETF is certainly worth keeping up with, but doesn't quite fit my investment needs at the moment. So this isn't in my portfolio, although that might change in the future, and I am definitely interested in the other yield max ETFs for stocks like Apple and Nvidia. Let me know if you decided to get a few shares of TSLY or if you decided to pass on it in the comment section down below. And be sure to like the video if you found it valuable, subscribe for more, and be sure to check out this video of my top monthly paying covered call ETFs here. See you over there.